Hey everyone, welcome back to Corporate Decoder. Today we're diving into OOMA's latest quarterly report, and let me tell you, this one's a real head scratcher. Are they soaring to new heights, or are they just really good at juggling numbers? Stick around to find out, because the truth is somewhere in between. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for people that want to chat about stocks and what's happening in the market. This is OOMA's report for the quarter that ended in April of 2025. It gives us a snapshot of how they were doing 3 months into their fiscal year, which doesn't align with the calendar year. OOMA, if you don't know, is a company that provides communication services and related tech for businesses and homes. They do it using clever software and what they call unified communications platforms. Let's get into the financials, because that's what really matters here. Their total revenue came in at $65 million. Not bad, right? It's definitely better than the $62.5 million they made during the same period last year. Breaking that down, most of their money, about $63 million, came from subscriptions and services. This is their bread and butter, things like monthly fees for OOMA Business and OOMA Residential. Then there is product and other revenue. That number lands at $4.80 million, and it's mostly from selling hardware like their OOMA AirDial devices. It's important to know where the money comes from. Now let's talk about profit, or rather gross profit. They are reporting around $42 million for the quarter. A gross profit is essentially revenue minus the direct cost of making those sales. But things start to look less shiny when you consider operating expenses, which basically include expenses required to keep your business going. This includes stuff like sales, marketing, research, development, and general admin. That number reaches to $40.3 million. Looking at interest and other income, we see a positive $0.2 million. When all the numbers shake out, OOMA reports a net loss. They ended up with a loss of $0.11 million. Though it is a loss, it's way better than the $2 views into dollars line to dollar variant arm. That translates to a loss of 1 cent per share as opposed to 8 cents lost last year. So it's still negative, but the direction is right. Time to see where the cash is flowing. Cash from operating activities. This is all the cash they got from running the business, was up to $3.7 million, a little bump up from the $3.6 million last year. But then we see they spent $1.2 million on capital expenditures, which is money they used to buy equipment. They also used $1.4 million in financing activities, mostly from stock repurchases. This includes repurchasing shares and tax withholding, offset by issuing new stock. It is not a great sign using that kind of money for repurchases when they are barely profitable. The overall impact, their cash equivalents and restricted cash increased by $1.1 million. So they're ending the quarter with more cash than they started. Let's dive into the balance sheet. This shows the value of things the company owned. First, inventories jumped up to $14 when from around $13.1 million at the start of the year. So they have more products in their warehouses. Their short-term debts, also known as current liabilities, went down to $49.3 million from $51.7 million. They also are reporting $23.1 million of goodwill on their balance sheet. The goodwill is there from acquisitions they did in the past, and it's basically an estimate of intangible benefits a company has from an acquisition. Investors should be very careful and skeptical about goodwill, as this might be overvalued and result in losses in the future. They also have $16 million deferred revenue. Amortization of deferred sales commissions, which represents expense from getting new customers to sign up, was around $2.6 million. Their investments in private companies are valued at $333 million. OOMA leases its offices, and that cost them about $1.7 million for 3 months. What else? They did not have significant revenue derived from customers located outside of the United States and Canada. There are also some legal issues. They are involved in legal cases in Canada, one related to how they market some of their services. Also, the business world is full of risk. Let's talk about those risks, because every company has them. OOMA has plenty of risks, and they break it down into areas relating to their business, security, regulations, and stock ownership. There is a very diverse variety of risks there. Now, looking at these results more broadly, OOMA is in a tough spot. A loss is still a loss, but the fact that they are at least moving in the right direction says something positive. They need to keep growing that subscription revenue and getting a better handle on cost. The fact that much of the revenue comes from small and medium business means they are more susceptible to economic downturns, but their push for OOMA business will likely pay off in the long run. That also the amount they are spending on stock repurchases when the company is not yet profitable might be something worth checking in the next report. Alright, that's our breakdown of OOMA's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for a community to chat more about this and other stocks. Thanks for watching. See you next time.